Hey everyone, we had a wild week in markets, so I want to bring a video to you that has a number of charts that we can take a peek at to try to understand some of the things that unfolded, potentially some of the things that are headed our way. We had a number of recession indicators that showed up, and one of the most popular this past week was the SOM rule, which I will discuss in this video. Now, all of this is going to be primarily from the perspective of the housing market, and one of the factors of this past week was a interesting move in interest rates, which created a very positive move for mortgage rates, one of the biggest drops in mortgage rates we've seen in a long time, almost on the historical scale. And if you aren't familiar yet, I encourage you to visit LendZen.com, where you can look at mortgage rates real time. You do not need any kind of login. There's no personal or contact information required. A lot of people don't realize that mortgage rates are determined nationally by the mortgage bond market. So you do not need to be asking for a quote from loan originators and banks. You can figure that out all yourself in a matter of seconds without any personal information at LendZen.com. So let's jump into the market. Let's look at things more so from the equity or macro picture. We had a number of things that unfolded. Let's start with the beginning of the week. So there was an FOMC meeting. That is where the Federal Reserve meets to make their interest rate policy decisions. They decided to not raise or change their overnight lending rate. So there was no hikes, no cuts. They kept it at roughly between 5.25% and 5.5%. But what was interesting is more or less the next day, the Bank of Japan, the central bank for Japan, decided to raise their overnight lending rate. This was significant because Japan has basically been at zero for almost 30 years, multiple decades. And what is so important about this decision, although it was just a small 0.25% interest rate hike, is that for a very long time, there's what is called the carry trade, the Japanese yen carry trade. I'm not going to get deep into that here, but understand the importance of it, where people were borrowing in Japanese yen very, very inexpensively when rates were at zero, and taking that money and investing it in other parts of the economy. Some would speculate that this sudden decision by the BOJ to increase interest rates had a lot to do with the equity sell-off that we saw this week, which erased 2.9 trillion, almost 3 trillion of market cap on Friday's sell-off. Now, part of what drove that potential sell-off is also the employment data, which we're going to get into. But that was a significant sell-off in terms of market cap, one of the worst days we've had since March 2020. Now, one other thing I want to add really quick that's interesting about the Japanese yen, the carry trade, and the BOJ's decision to raise the overnight lending rate. So anyone who's been paying attention in recent weeks, the Japanese yen has been getting incredibly weaker against the dollar and other currency pairs. In terms of the dollar to yen pairing, the yen got as high as 160. Technical analysis, which is more or less looking at charts and various trends and patterns of the past to try to decipher where things are going in the future. The 160 line was very, very significant. If the yen continued to weaken beyond that, there was potential that it would spiral out of control. There was clear intervention by the BOJ going into the currency forex markets to bring that yen pair down. And by doing so, they started to see some relief where, as of this past week, the yen was now trickling below 150. So a lot of improvement there, but there's also some concerns as to what other factors that might be triggering, as well as what ammunition the BOJ is using to achieve that. And as a result, that could have been why the BOJ decided to raise the overnight lending rate instead of using other assets and collateral they have, like US Treasuries and dollars, to defend the peg. Maybe perhaps doing this shock rate increase was another way to draw capital back into Japan, where people were unwinding that carry trade, selling their assets overseas, their dollar denominated assets perhaps, and moving back into yen to add further strength to the yen, to give some stability to that currency market. But at the same time as doing that, they definitely caused a bit of chaos in their equity market, where the Nikkei had one of the worst weeks since 1987, goes way, way, way back. So, the US had this 3 trillion market cap wipeout on Friday. Japan has been dealing with all kinds of currency weakness, and then they had a really rough week after the rate hike where the Nikkei more or less got clobbered. So definitely some stuff to watch there, because when you have a risk on environment where people are very enthusiastic about the direction of the economy, or at least they're willing to take risk and buy equities, so on and so forth, Those types of situations, when they reverse, can accelerate very, very quickly. And as a beneficiary of those risk off moves, you do see capital tend to flow into the US bond market. And so there's a number of factors this week that helped accelerate the bond rally that we had, which was good for mortgage rates. And so we're going to talk about that. But keeping an eye on the economy, we've also seen weakness in other places. For example, the bankruptcy business filings for bankruptcy in Chapter 11 are now at a 12-year high. So that is concerning. We also want to look at the real economy oftentimes when we're talking about things that are going on in the stock market and the financialized aspect of the economy. It doesn't necessarily reflect the true economy. Employment is one of the important areas we should be looking, and the manufacturing sector is an important one. And so one of the things that we saw this in recent data is the ISM, which measures various manufacturing indicators. And these things generally are surveys that are taken from different producers and manufacturers in the economy. There is strong concern as orders have declined below recessionary territory, what is typically a recessionary territory. So that's something to keep an eye on. In addition, the type of employment that we're seeing in those sectors has also declined. Now, this type of decline in manufacturing jobs is not something we've seen outside of a recession in 21 years. So this is adding to the speculation that we are headed to a recession, which adds fuel to the fire we saw this week in the equity sell-off, which also encourages a lot of that rotation out of equities into bonds, which was a big part of this past week's story. So in addition to the manufacturing sector, just overall, we're seeing an increase in jobless claims. And this is important because one of the things that the Fed is focused on, they have a dual mandate, price stability, which is more or less not letting inflation run out of control, which obviously they've done a very poor job of the last 2 years. The other aspect of the dual mandate is full employment. So when we start seeing jobless claims increase and other types of signs that the employment sector is weakening, then it points to the likelihood that the Fed might be looking to ease a little bit. And there's already been a ton of speculation the past month or two that September would be when they cut rates for the first time. But the 32-month high in jobless claims is adding fuel to the fire of that speculation. And we have seen the way that Fed funds futures are pricing that, markets are now expecting anywhere from 100 basis points in rate cuts by the end of the year. And we'll look at some charts on that here in a second. So, as far as Friday is concerned, we had what's called the non-farm payroll report. That is an employment survey report, very heavily watched and monitored both by the Fed and market participants. Now, that came out well below expectations, and there was a slight uptick in the unemployment figures. Now, there are some people pushing back that this could potentially be a one-off sign, and it very well could be true. One of the arguments being made is that the uptick in employment is more just temporary workers, or some of these layoffs would be temporary. As you can see in this chart, the rise in unemployment is not just in the temporary sector, and we're seeing full-time jobs ending up in the layoff category as well. So that's a worrisome uptick in employment, very important data set to watch. And the other arguments around weather being a factor, and that the employment sector actually is, still robust, and that this was more a weather impacted change to employment. Some of that is outlined here in this chart, and it's a bit noisy, the data here, but it's one of those things to keep in mind. More important than one data set is the trend. So we'll see how some of this weather impacted change in employment, and how the overall balance between full-time employment and temporary workers, how those layoffs balance out probably in the next 30 days. It'll be very, very telling, because we do have both an inflation CPI print and a non-farm payroll employment data set coming out before the Fed meets again in September. So with the data that came out on Friday, the non-farm payroll, the unemployment rate reached 4.3%. Now, this was the big talk all week. This, because of that uptick in unemployment, it triggered what was called the SOM rule, which since 1953 has 100% accuracy of predicting recessions. And you can see that on the chart here, historically, when that SOM rule was triggered, and then when we were already in recession, or when a recession then there followed. So it's something to keep in mind on. But, market participants, we get really excited about this type of forward-looking guidance. We're always trying to be one step ahead of markets and where markets are moving. So people do really get excited about a lot of these different types of recessionary predictors. One of the more popular ones, in addition to the SOM rule, is the inverted yield curve. Now, this is one that's probably more well known. What an inverted yield curve is when the interest rate on longer duration bonds is less than short-term T-bills and short-term bonds. That would happen because investors are more worried about the long-term outcome of the economy. And there's other factors in terms of how governments are funding themselves that can influence that. But generally, it's considered a risk-off move for investors that they're uncertain about the future outlook. And so they want to protect themselves for a longer period of time than what the short-term T-bill would give them. 3 to 6 months, maybe not enough of an insurance policy. So as more capital flows into the long duration bonds, it can push the yield on those bonds lower, which typically would not make sense. Because if you're going to give the government or any borrower money for a longer period of time, you should be compensated a higher interest rate because there's more risk. Now, the argument is also being made that the reason the yield curve has been inverted and is inverted as long as it has, this is actually the longest inversion in history, 518 consecutive trading days, almost 18 months. This surpasses the 1978 to 1980 inversion under Fed Chair Paul Volcker. And usually once you have an inversion, somewhere within a year, a little bit longer, it's different throughout history, you end up being in recession. So the fact that this one has gone on as long as it has, we haven't had the types of things that would prove of a recession, there is even more attention on the inverted yield curve and when potentially it's going to disinvert. Because when it's no longer inverted, that's usually when the recession is right around the corner. Now, the US Treasury has kind of playing some games, if you will, or some would argue that they have been, where they've been doing a lot more short-term T-bill issuance, and therefore the supply of longer-term government bonds is a lot lower, and that would mean less supply. If demand stays consistent or even increases slightly, there's going to be a greater potential of a yield curve inversion because there's more capital chasing less supply. While on the front end, on the shorter end of the curve, the Treasury is flooding the market with supply. So how much of this long-term inverted yield curve is real and really a condition of the market being uncertain about future outcomes and or just some Treasury manipulation? Either way, it is starting to disinvert. We're now just 8 basis points, 0.08 away from the curve no longer being inverted. And as I mentioned, usually when that happens, you're in a handful of months away from recession. So when you look at all the things that have been going on last week, the unemployment data that came out, some of the chaos in equity markets, both in overseas markets and in the US, then we have the SOM rule triggered, the yield curve has been steepening and is almost no longer inverted. These are all very, very interesting signs that the market is excitingly watching. So as I hinted at really briefly before, because of a lot of the weakness in the economy and some of the things that we're seeing, the market is already starting to price in with what is called Fed funds futures, where they think the Fed is going to be, how many rate cuts we're going to have. And they're already pricing in 100 basis points by the end of the year and potentially sub 3% on the Fed funds in 2025. Well, right now we're at 5.5, 5.25 to 5.5. So that'd be quite a few rate cuts if it was all 0.25% rate cuts. You're looking at potentially anywhere around 8 cuts for something like that, which is a sizable number of cuts from here. But they certainly could be more aggressive on the way down and do, instead of 25 basis points, 0.5%, 100 basis point cuts. If the Fed comes out and starts doing those much more sizable cuts, I think we're already in some sort of chaotic environment. So we'll keep a close eye on that. Now, keep in mind, as we go into this next set of information where we're looking at the housing data, as I mentioned earlier, the bond market really took off this week, benefited greatly from the concerns of where the economy is headed and certainly the sell-off in equity markets. As a result, mortgage rates were the average mortgage rate, which is a bit of a convoluted data set, which I'll talk about here in a second, was the lowest since April 13th, 2023. So well over a year ago, and that was when we kind of had this regional banking collapse or crisis. You had Silicon Valley go down, you had Republic Bank. So it's not since then that we saw, bond yields and mortgage rates this low. The other contributor to the fact that mortgage rates not only had one of the biggest drops in a long time this week, but we also saw spreads tightening. So what a lot of people don't realize is that mortgage rates are derived from the mortgage bond market. They're not directly correlated to what the Fed does with their overnight lending rate. And so as investors are buying into the bond market, generally the US Treasury market, an alternative option is mortgage-backed securities. Historically, the spread between the two is less than 2%. So maybe 175 basis points, 1.75. So we would think that if, now that the 10-year Treasury bond is under 4%, but let's, for simple math, so you can follow with me, let's say it was 4% today, and the spread between mortgage-backed securities and the 10-year was 200 basis points. You would expect mortgage rates to be somewhere around 6%. So what's important to understand in respect to that is that because mortgage-backed securities and the bonds that are issued against those securities are what drive mortgage rates, everyone is going to be selling the same rate at any given day, or a range of interest rates at any given day, but with a margin added on top. A lot of people don't realize that the mortgage industry is really just one big sausage making process. Everyone is selling you the same loans because interest rates are priced universally off of these mortgage-backed securities provided by the government-sponsored entities that many people know, Fannie Mae, Freddie Mac, and in regards to government loans, Ginnie Mae. So when you're looking at that marketplace and investors are buying into those bonds, they're the ones that are really driving liquidity at different interest rates. And so what I encourage you to do is visit LendZen.com so that you can see interest rates in real time and understand that mortgage averages is almost a meaningless figure, because what is that average really calculating? And generally what it's calculating is where people are offering interest rates at a given time, but it doesn't really tell you at what price. So to say that this is the lowest average mortgage rate of 6.4 since April 13th, 2023, what does that mean? What is the average calculating? Is that a no points loan? When what does points even mean? Is this a par rate? Is this a rate with rebate? So all of those things I think will become more clear when you go to LendZen.com and you kind of look at how interest rates are priced. The lower the rate, the more expensive it is, because you're more or less incentivizing that bond market to take less yield on their investment, and therefore you have to pay them to take that lower interest rate. In the industry, we call it a discount fee. A lot of people refer that to points. So if you're in the mindset that this is just the beginning, right? We've got a lot of economic uncertainty. We have the SOM rule being triggered. We have inverted yield curves very quickly no longer being inverted and being inverted for the longest in history. These things are suggesting recessions around the corner. When recession is around the corner, you see more and more investors rotating into bonds, which would push the yield on bonds lower, which would mean mortgage bonds would follow. And so you want to think about what interest rate, if you're going to do a refinance, makes the most sense if the potential is in the next year or two, interest rates are going to be even lower. LendZen solves all that instantly. So check it out. All you have to do is click a few buttons, choose a rate, and the analysis is done instantly for you based on whatever timeline you want to choose. And so if you think interest rates are going lower in the next 6 to 12 months, I encourage you to use a 1-year timeline on LendZen so you can see what the recommended rate comes out to be, where the market on a higher rate is going to incentivize you by paying you a rebate instead of you paying the market. So there are some strategies there for you to consider by taking a higher rate today and using those rebates to offset your closing cost, so you're in a better position to refinance again should rates continue to decline. So let's look at the housing market and the resilience of the housing market overall. This is a very touchy point because home prices accelerated dramatically over the last 2 years. A lot of people would argue this is unsustainable, perhaps, but one of the biggest factors that's keeping the home prices stable is inventories, and inventories are slowly starting to increase. So we're going to look at some of that data. But when it comes to home prices based on the Case-Shiller Index rose 0.86%, so just under a percent month to month from April to May. Year over year, they're up 6% or 5.9%. Since March 2020, which is when a lot of these the jump in home prices really started to take off. The average home price or the median home price is up 50%. And since the 2022 peak, home prices are still up 5%. Now, it's all about location. We know there's some markets that are extremely weak, maybe down from the peak 10 or 15%. There's other markets that have continually risen in that median average of 5% or more during that same 2-year run since 2022. So, obviously this data is looking at the market broadly, but we as home buyers and home shoppers are looking in very localized markets. So, take it for what it is. Make your own decisions based on what you're seeing in the local markets, but keep in mind there's still, in a broader sense, a robust housing market where, which you'll see here in some of this additional data. Not only are home prices not really budging, the inventory increase is actually in the healthy range. This isn't like a sudden flooding of inventory. And again, that can certainly change, but we want to look at the data objectively as it is now. So you can see, some of the charts I'm showing on the screen. The median sales price in some of the major metros has pretty much just been a continued increase since 2012. And I think this is where a lot of the frustration and anger oftentimes that I see towards the housing market and this emotional expectation that the housing market's going to crash is because people were holding on to a double dip narrative, expecting a much steeper second decline in the housing market after 2010 and 2011, and it never came. And from 2012 on, it's just been straight up. Now let's look at the inventory. So last week, inventory grew by about 6,500. As a total, we're now sitting at about 683,000. It's a nice jump from last year, which at this time we are at about 488,000. The inventory at this point is something that, as I mentioned a moment ago, we need to keep a close eye on, but it's actually at numbers now kind of right in the middle. As you can see on that chart, it was higher in 2017, 18, and 19, much lower during, the post 2020 era. We're kind of settling right in the middle there. This is a healthy place where we can start to potentially see home prices maybe flatline a little bit. And if interest rates come down, make affordability a little bit more palatable to many of the home buyers who've been waiting for a good opportunity to get in. Now, as you can see, the number of homes for sale has increased. And for the most part, as I mentioned, I feel like it's increased in a healthy way, giving more inventory, some subtle price declines, giving home buyers a slight edge. But overall, we're still well below where we were pre-2020. We just, for the most part, really have not been in a healthy inventory environment. And we're hopefully going to be getting back to that, which should help balance things out. So the number of listings this time over the last couple of years, we are roughly at about 67,000. And somewhere right in the middle between the last 2 to 3 years, 2022 had more at this time, right around 73,000. So not a lot. If you're bearish on housing, there's not a lot that's to be said there or in this data just yet. But if you're going to see employment continue or unemployment continue to tick up, and you're starting to see some of these other factors in the overall broader real economy continue to weaken, then we're going to definitely have to keep a close eye on what inventories are doing. You can see the new number of listings is also kind of right in that sweet spot in the middle. It's not doing anything dramatic, and it's already kind of rolled over slightly. I think for me, the most important thing, and many of the people in the housing market, specifically home builders, what they watch closely is the months of supply. 3 months of supply is very, very tight. And I think this is going to continue to support a robust housing market and stable home prices. The long-term average, which you can't really see on this chart, is closer to 6 months. And so we're still well below that. And so, until we see obviously the inventory is ticking up, but if the market is absorbing that quickly in the months of supply, based on new listings and the number of pending sales, keeps that number at below 6%, below 6 months, we're still, relatively speaking, in a seller's market, or at least a healthy housing market when it comes to home prices. So price reductions are another one. People are highlighting as a concern that there's stress in the market and that sellers are in some form of panic. The percentage of listings with price reductions is around what we've seen the last 2 years. I'm not a huge fan of this data because keep in mind we're in a lot of markets 50% higher than we were in 2020 in terms of home prices. So if someone's listing a home at 50% higher than what they paid for it, and potentially much, much more depending on how long they've been in the home, the subtle price reduction doesn't necessarily say much. And every seller I think is going to try to get the most they can. And if they price slightly high and don't get the activity or interest, a price reduction makes sense. And so the percentage of listings that are showing price reductions doesn't matter to me as much as how big of a reduction, and again, how many months of supply that we have. And the number of days on market, when you looked at that previous chart, there's a little section right there that says the median days on market, and that is right around 32 days. So all in all, there's not a lot of, I would say, concern or panic for anyone in the housing market, although things have not been well balanced, or we would say healthy, the last couple of years. So pending sales, right now we have 4% more single family homes in contract than last year. So is that a good thing because more people are buying, or is that somewhat a signal we should watch because there's more homes coming on market? So how much of that is just an increase in inventory versus an increase in activity, given the fact that the inventory isn't really significantly up compared to the last couple of years? That's actually a healthy figure in my view. There's plenty of buyers out there that are trying to get into homes and are finding the homes at a price point that they like. And lastly, I'll share a chart here that shows some of the migration. This has been something I think we've been aware of the last couple of years, how you have a lot of people moving out of states like California and the Northeast, whether it be weather related or tax related, lifestyle related. Florida has been one of the biggest beneficiaries of that. Because of that, Florida has also become the poster child of where people are looking for weakness in the housing market, pointing out different things that are going on with the cost of insurance increasing, the cost of HOAs, homeowner association fees and dues going up because of the requirement to do assessments on these condos, many of which need a lot of work. And once that assessment gets done, the HOA fee needs to increase to refill the reserves and the Treasury that's going to ultimately pay for the repairs that the assessment has deemed necessary. So that's made Florida a hot topic right now, where if there is weakness, it's in the condo market because the cost of owning a condo has gone up dramatically in certain areas because of those assessments and the increase in HOA fees. And there's obviously a lot of issues with getting affordable insurance depending on how old your home is because of the severe weather that sometimes passes through Florida. And so the newer homes don't really have as much of an issue because they're built hurricane proof, but some of the older homes are seeing an interesting jump in the cost of insurance. So hopefully you found this informative. Like I said, a pretty wild week. It's going to be interesting to see what unfolds the week upcoming. And as always, please visit LendZen.com so that you can keep a real-time pulse on what's going on with mortgage rates. You don't need to wait for videos like this. You don't need to call a human, a loan originator, a bank, none of that. The mortgage industry is very, very centralized, and consolidated mortgage rates are pretty much standardized nationally. So we've created LendZen. We removed the barrier so that you can have access to those mortgage rates, the same tools that professionals use to give you price quotes that usually take days to get back to you, you can now get in seconds without providing any personal information. And I think you're really going to love the analytical tools that are provided once you pick an interest rate that help you determine if a refinance even makes sense for you, both cash out or just if you're looking to lower your rate. So I think there's a lot of great information at your fingertips there. So please visit LendZen.com, LendZen.com For everyone who's stayed with me this whole time, thank you very much. Hopefully you found this information in the charts informative, and I look forward to speaking to you again very soon. Hopefully we have some excitement to share next week, but if it's all quiet, then maybe it'll be a little longer before I catch up with you again. Until then, have a great week. Talk to you soon. This show is provided for entertainment and informational purposes only. It should not be relied upon as legal, business, investment, or tax advice. Neither the hosts, guests, nor any funds they may manage intends to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies.